One of the main reasons investors don't win a contract when they're making offers on properties is because they don't know how to properly run the numbers. And if they do, it takes them so long. And by that time, savvy investors have already put their offer in and are working to get to close on the contract. Now, in this video, I'm going to show you exactly how I evaluate commercial multifamily deals. And this is 4 simple steps. And I'm telling you, once you get good at this, you can do this in 60 seconds or less. And I believe this is exactly how I have won so many contracts, is because I can get my offer in, get a proof of funds to the selling team in a matter of minutes. And that shows that I know what I'm doing, I know what I'm looking for, and I have the ability to close. So let's jump into this. I'm just gonna overview what my strategy and my goals are really quick. You might see me with a paper towel in here. We just moved into the office. We don't have the air conditioning set up yet. So I'm just gonna grip it and rip it, baby. We're not gonna do any cuts, no editing. We're just gonna dive right in. So my strategy and my goals: I am a BRRRR investor. Buy, renovate, rent, refinance, and repeat. I do this with commercial multifamily the same way that you can do this with single family homes. And my goal with that is to own 100% of my portfolio. When I go gain territory, I want to keep the entire pie. Now, this is not to bash people who do partnerships or syndications. This is simply how I want to build out my portfolio. There are certainly opportunities for partnership in the future, but what I want to build is a strong financial foundation with my deals that I own 100%. And I think that's going to be the key to really creating that generational wealth, that incredibly strong cash flow that we see other people talking about on social media. So why do I do this? Syndications, partnerships, I think that there's a lot of muddy waters that can happen if you don't really do it the right way and you don't have that foundation of strong financials from an existing portfolio. You might need to stretch for deals or reach or make something work, or ignore red flags in syndications and partnerships that if you didn't need the money, you didn't need to make a deal happen, you would call those things out and walk away. One of the reasons I'm making this video is because, online you've probably seen, if you're familiar with Brandon Turner, he posted a post on Instagram talking about how he had a syndication gone wrong, where he ended up needing to bring about $15 million to the closing table, there's $15 million that he's not able to pay out to his investors. Now, this is something that we're seeing on the forefront in the real estate market, but what's happening behind the scenes is this is happening all over. The only difference is Brandon Turner actually has a high level of integrity and says, I'm going to put this out there. I've got a reputation to uphold. And that reputation is built on a foundation of integrity, where there are people and deals that are going south really fast. They're handing over keys. They're losing investor money. But these are the types of people that are going to go into hiding. They're just going to back away slowly and hope that nobody finds out, or just wait long enough until people forget and then come back into the market. So Brandon Turner had talked about losing that $15 million because he got into deals and he didn't really understand the market, or he anticipated the market wouldn't shift. But as interest rates go up, he looks to either sell or refinance that property, but the value is just not there. We'll save that for another video, but another reason I'm making this video, and another reason why I want to own 100% of my portfolio, is a simple verse in Proverbs, which is Proverbs chapter 13, verse 22, that says, a good man, I'll read it here, a good man leaves an inheritance for his children's children, but the sinner's wealth is laid up for the righteous. I believe when you own 100% of the portfolio, you have the whole pie, you get to leave much more behind. And that goes a lot further from generation to generation, rather than just creating wealth for this lifetime and this lifetime alone. When you own 100%, you have way more freedom of maneuver, way more freedom of choice. But let's jump into step one, which is of evaluating commercial multifamily properties. Step one is income. Why is income step number one? Obviously, it's fun. We like to make money and we want to know how much this property is going to generate. But obviously, we need to understand that metric first because it is going to dictate the value of the property when it's all said and done. When we refinance, when we get a property stabilized, what is that property going to bring in gross profit-wise? And this is going to determine the value because commercial multifamily is based on value, based on income. The more income it makes, the more valuable the property becomes. And there's a number of different ways to do this when it comes to commercial multifamily. Since we're not bound by the sales comparison approach with 2 to 4 units or single family homes, we can increase the value of the property by rental income. We have washer and dryer, coin operated laundry income. We have storage. We have Wi-Fi. We're actually getting ready to do this on a 17 unit right down the road here, where we're going to provide Wi-Fi service to the building. It's going to cost us $15 per unit, but we're going to charge a $35 fee to the renters. Still a great deal for them, and we get to make about $20 per unit, which is $340 per month, which adds about $45,000 of value to the property alone when we bring that income into the deal. And of course, parking. You know, if you only have a certain number of parking spots available for a particular building, and there's the parking spots or the number of units exceed the parking spots, you can charge for that, and that generates more income, thus increasing the value of the property. So we want to know that number first. Step two is we need to understand the net operating income. Net operating income. And the explanation of this is you have your gross rental income, and then you subtract all of your expenses. This is your maintenance costs, your capital expenditures, your utilities, which you shouldn't be paying. You should be paying very little, if any at all, when it comes to commercial multifamily. But this is going to be anything that you do to actually run the property. The expenses does not include what we call debt service or our mortgage. So our principal and our interest are not categorized under net operating income. So the money that's left over, you take your gross rental income, you subtract your net operating income, and you're left that number. You pay the mortgage, the principal and interest based on that number. So the expenses will still include your taxes and your insurance if you're familiar with PITI, P-I-T-I, principal, interest, taxes, and insurance, typically wrapped up in your one-time mortgage payment per month. But we delineate the two, principal and interest, taxes and insurance. This is expenses. This is debt service. So we get that number, and when we're evaluating a property, let's say a selling team sells us, or they give us the expense sheet. So we're saying, what has the seller, the current owner, been paying for this property in expenses? Now, I do not recommend just taking their word for it. Most people are not very good at bookkeeping. Most people are not very good at running a tight ship when it comes to their numbers. So we're going to build that number in on our own. And an easy way to do that is 50% expenses. Now, you're most likely not going to operate at a 50% expense ratio, meaning of your gross rental income, 50% of that goes to expenses, and then we pay the debt service, that principal and interest. However, we run very conservative because the strategy is BRRRR. Right? So when we're BRRRRing a property, we need to be able to, once we've renovated the property and go to refinance, we need to be able to get all of our money back. That whether that's my money or whether that's investor money and hard money lender money, we need to be able to get it all back for this to categorize as a BRRRR. So when we're running our numbers, we run very conservative. So I recommend cutting 50% of your gross rental income to expenses. This gives us a ballpark. And let's just say that we have $90,000 or $180,000 of annual income. That's $15,000 per month for this particular building. If we run a 50% expense ratio, that's going to give us a $90,000 net operating income annualized. And from that $90,000, we pay the debt service, the principal and interest. And we're going to put this all together. I'm going to wrap it all together in a nice little bow, but we're going to keep going through the steps here. Step 3 is we're looking for the market valuation based on these numbers. This is not what we pay, but this is what the property should be worth once we've increased the rental income to its maximum, once we've decreased our expenses to the best of our ability, sharpen those operations, and then we multiply that by the loan to value that the bank is willing to give us. But we take all the numbers that the property is currently operating on, and then we run these numbers. Net operating income is then divided by the cap rate. And I'm not going to go into a lot of detail on the cap rate. Honestly, it's a super confusing number, but once you understand how to use it, you can use it to your advantage to understand what you should be paying for properties, what the valuation is. So a cap rate is simply what are properties trading for in any given market. The higher the cap rate percentage, the less stability you have, but the greater return. So we know this when it comes to stocks. The higher or any investment really, the higher the risk, the higher the return. Here in my market in Northeast Ohio, the market is more volatile because there's not tons of people moving to Northeast Ohio. Now, another market in Ohio, say Columbus, lots of people are moving to Columbus. So your cap rate is going to be lower, meaning you're probably going to have less return, but it's a more stable, a more predictable return because lots of people are moving to Columbus. So the lower the number, the less you're going to make, but the more secure. And one more time, the higher the number, the less secure your investment, but the more you're able to make. Now, because we have the beauty of real estate investing, people always need a place to live. And because of that, even though I live and invest in a more unstable market, we have a great investment vehicle and a great opportunity because people need somewhere to live. So in order to get this, we're going to take that $90,000 net operating income, because remember, we had $180,000 of gross rental income. We cut it in half with a 50% expense ratio, leaving us $90,000 of net operating income. And then we divide this by what properties are trading for in our market. I typically run this at a 9% cap rate, sometimes between 8 and 10, but I met in the middle for the purpose of this video, and we're gonna do a 9 cap. So we take that $90,000, we divide it by 0.09, and that equals $1 million. So that number right there is what the property is worth once we've renovated the property, we've rented it out at market value, and it is 100% occupied. And that's running at a 50% expense ratio. Now, that is not the number that we pay. That's just what the property is valued at. So now what we do is, because we took the $15,000 per month times 12, and again, these are renovated numbers. What we do now is we take that $1 million and we multiply it what the bank would be willing to lend us when we go to refinance. What is the bank willing to lend us when we go to refinance? That's your loan to value. And typically for commercial real estate, that is a 70% loan to value. So if we take $1 million, we multiply it by 70% or 0.7, that gives us a valuation of $700,000. So what that $700,000 tells me is that needs to be my all-in cost. That's purchase price, that's renovation costs, that's investor interest paid back, as well as their principal. That's our all-in cost. That's our holding cost built in, so we don't have to come out of pocket. So what do we do with this number? Typically what I do is I'll take that $700,000 and I will subtract the capital needed to renovate the unit. So what that typically looks like is, let's call it $10,000, easy numbers for the sake of the video. So if we are working off of a 15-unit building, that's where we're getting the $15,000 gross rental income per month. It's a 15-unit building that's bringing in $1,000 a month at market value post-renovation. We take that $700,000, $10,000 per unit would be $150,000. And what we can build into that $10,000 per unit is our holding costs, our materials costs. And something like this would be a pretty light rehab. So we subtract those numbers, and that leaves us with $700,000 minus $150,000 is $550,000. And that, my friends, is your offer. That is the number that we submit in our letter of intent, and that is the number that we submit with our proof of funds. We can buy this building for $550,000. Here's my letter of intent to buy at $550,000 with the other stipulations of how we're going to close on this deal in that letter of intent. We can do a whole other video on the documents necessary and how to prepare to actually make your offer, but just to keep it focused on what we're talking about, which is how to evaluate any commercial multifamily building, we'll just keep it brief. So $550,000, and again, the reason for that, and you might be thinking nobody's going to take that offer. You know, nobody's going to take. They might be asking for $900,000 for this building or $800,000 for this building. But we're offering $550,000. Or if this is an off-market opportunity, we have a little more wiggle room in terms of what we're going to offer. However, to really win this strategy, the BRRRR to keep 100% and to be able to pay out our investors, it's all about price. It's price, price, price. First, location, location, location. Second, both criteria need to be met in order for us to want to win these properties. Just because something is super dog cheap doesn't mean that we should be buying it if it's in a war zone and it's going to be a management headache. I can tell you right now, we've got some properties and they're in C- areas, but they come with a higher level of risk. They come with a higher level of break-ins. They come with a higher level of just different things that will happen in that area. We've been, I would say, fairly blessed when it comes to some of our properties that aren't in the greatest A+, B+ areas. We've been pretty blessed, but things do happen. And that is a strain on the management side. But again, going back to that 550 number, we're not going to pay for the work that other people didn't do. The sellers are going to want to sell as if they've done the work, but they haven't. Oh, well, the property will be worth this when it's all fixed up. Yeah, but I've got to be the one to raise the capital, put the money into the deal, operate the deal, go through evicting or removing all of the garbage tenants that you had in the building, which adds to the holding cost, which adds to the mental strain, which adds to the length of time that this project takes. And the more I'm going to be paying my investors, I am unwilling to pay for the work that other real estate owners did not do. So that's why we offer at such a low rate. And we might have to make 100 offers. We might have to make 200 offers to get a yes. We're going to get no after no after no in order to get one yes. But that one yes could be a property that changed your income levels for life. That one yes could be the one stepping stone, the one door knocked on that once opens up the floodgates of momentum to have you enter into a new financial level, a new level of capacity. Because I know when I bought a 6-unit, it was my first property really that I was doing the entire renovation on my own. And it needed to be, this was an entire renovation, each unit. We had ceilings falling in, we had mold growing, we had all kinds of issues. Plus, we were renovating top to bottom. In going through that process, my capacity to deal with more, to handle more, grew exponentially, because the next purchase after that was a 28 unit where we needed to renovate every unit, and we had all kinds of issues with that. And then literally just a month later, we closed on 17 units where, again, it was the same strategy. And again, the BRRRR strategy, it hurts in the short term because your cash flow is very little. But once we get through the renovation stage, and even months and months after the renovation phase, you actually begin to stabilize these properties. That's a whole video in itself, how long it takes to stabilize some of these things. But the cash flow is real. So we're going to have to make a lot of offers. And this is exactly how we build out that portfolio. So let's run through the steps one more time. Step one is we're going to take our income. How much is the property making annualized? In this example, $180,000 gross annual income. And then we take 50% of that and we get $90,000. And then we take that $90,000 of net operating income and we divide that by our cap rate. In this example was a 9% cap rate, which gives us a valuation of $1 million. From there, we multiply that by the loan to value that the bank is willing to give us, 70%, which gives us a total all-in cost of $700,000. And from there, because ladies and gentlemen, we're not done yet, we're going to take $150,000 of renovation capital, holding costs, what have you, and we subtract $550,000 or $150,000, $10,000 per unit, 15 units, gives us $550,000. And now we've got our offer. And I'll tie a bow again I use a hard money lender who will give me the vast majority of the acquisition cost. And then I raise private capital on an 18-month term, and I pay somewhere between 8 to 12%. And we pay quarterly. And that's the money that I use for the down payment if necessary, any closing costs if necessary, as well as holding costs, the renovation capital, and all of the things required for me to get through that deal without having to bring any of my own money. However, there is money. I have reserve accounts. I have the funds. If something goes south, and I'm telling you, things will go south as you begin and go on this journey, to have the capital to inject into the business, whether it's paying out investors, whether it is just keeping a project moving strong, and just making sure that we get it across the finish line, refinance, everybody gets paid out, everybody is happy. So again, this is how we build a portfolio to keep it 100%. And this strategy of how to evaluate any commercial multifamily property, I do this. I'm telling you, in 60 seconds, I can get my number and I can send an offer. And by sending that offer so quick, what does it communicate to the selling team? This guy knows what he's looking for. He knows what he's doing. And a lot of times sellers just want a guaranteed close. Sometimes they want to hit their number, and that's where we'll get a no, a no, a no, a no. But sometimes sellers just want a guaranteed close so they can do the next thing. They can inject that money into their business or their family or their emergency. And this is how we win contracts, ladies and gentlemen. This is how we win contracts. And then you rinse and repeat, rinse and repeat. You do this over and over, and then you build something that it lasts. Going back to Proverbs chapter 13, verse 22, a good man leaves an inheritance to not just his children, but his children's children. And building a portfolio that you own 100% is exactly the way to do that. I hope that this video served you. I hope that this video blessed you. Leave a like, comment if you have any questions, or if you want me to make a specific video, I'd be happy to do that. I'm going to continue to post how I build my portfolio in all things real estate, all things faith, all things family. May God bless you and Godspeed.